Before we dive in, a quick note: this video is for educational purposes only. It's not financial advice. Trading involves risk, so always do your own analysis and manage your risk carefully. Now let's get into it. When analyzing any chart pattern, the real winning edge you need is the ability to read the crowd and understand the order flow between buyers and sellers. You should be able to see human behavior reflected in the chart. You need to understand the sentiment behind price movements. That's how you can be more active and confident in a trade. In this video, we'll explore the psychology behind the head and shoulders pattern, how to recognize it, how to confirm it, and finally, how to trade it. Welcome to the world of chart reading. Let's first look at what exactly a head and shoulders pattern is. After watching this, you'll also know how to identify other chart patterns. In an uptrend, a proper uptrend, every swing forms higher highs and higher lows. Price continues to make a new higher high with every swing. Let's set aside the higher lows for a moment. Here is where the story begins to change. In an uptrend, there should normally be another swing that makes another higher high. But when buying pressure starts to fade, and sellers begin to reject higher prices, the next swing forms a lower high instead of a new higher high. This combination of three swings creates the head and shoulders pattern. When this pattern forms in an uptrend, it's considered a trend reversal pattern. If this happens near a strong resistance level, that gives even more confirmation. The first part is called the first shoulder, commonly called the left shoulder. The second higher peak is called the head. And the last lower peak is called the right shoulder. When you look at it, it resembles a head with shoulders on either side. Now let's dig deeper into how this pattern develops, and how to confirm it. Go back to where we started. The trend is moving upward strongly. We can confirm an uptrend by drawing a trend line that connects the swing lows. In an uptrend, that trend line acts as diagonal support. Notice how each swing respects that line and bounces off it. But here, price pierces through that trend line and even moves below it. In price action terms, this is a breakout from a bullish trend line. This is our first clue that momentum in the trend might be slowing. Next, the new swing fails to make a new higher high, which it should have done in a strong uptrend. That's our second clue that the trend may be reversing. In many cases, the right shoulder forms when price retests the breakout area of this support line. To get more confirmation, we draw a line connecting the lows of the two recent swings. This is a very important part of the head and shoulders pattern and is called the neckline. When the price breaks through this neckline and closes below it, that's a strong confirmation that the uptrend is finished and a reversal has started. After this, there's a high probability of a downtrend, and sometimes a sideways trend may follow. Now let's think about what's happening in terms of buyers and sellers, the sentiment behind the moves. Back to the start of the uptrend. As time goes on, new buyers enter, seeing the market rise. Traders who entered earlier continue to hold, pushing the price even higher, creating a new high. At that high, some traders take profits, and some short sellers step in, looking to capture a pullback. This causes price to drop and settle. That's the left shoulder. When price returns to an old support level, new buyers find it attractive and enter again, pushing the price upward. Short sellers who sold earlier exit their trades, which adds more momentum to the up move. Now, all the buyers from this region, along with the new buyers, are happy as the price rises, so many of them keep holding. Price then makes a new high. At this stage, some buyers take their profits again. Short sellers also enter again. Price corrects downward. The important point here: many traders now believe the price won't go much higher, so they aggressively close their positions. As a result, buying interest weakens. This causes a stronger pullback. This pullback breaks through the trendline support, and price makes a new low below the previous support line. Many buyers are still holding their positions, expecting another upward move. This is the head of the pattern. As price drops, some traders see this as a discount and buy, trying to push price up again. Short sellers also take profits here, which helps price rise a bit. But this time, there isn't enough buying strength. Price fails to make a new high compared to the previous peak. At this stage, buyers from the left shoulder are at break-even, and those who bought during the head are at a small loss. Because there aren't many new buyers, we can say that bullish strength is fading. Now, new aggressive short sellers enter the market. Even more buyers exit their trades, locking in profits, causing price to drop. In most cases, the selling volume during this pullback will be higher than before because many traders from earlier exit their trades. When price finally breaks through the neckline, panic sets in. Traders who went long earlier exit their positions in a hurry, which adds to the selling pressure. This is the point where sentiment shifts completely from bullish to bearish. Now, how do we trade this? Since the head and shoulders is a reversal pattern, we need to know how to trade it effectively. There are three main styles. Aggressive method. When an aggressive trader sees a break in the trend line and a drop below it, they wait for a small upward move and then enter based on a candlestick pattern or a support-resistance flip. This is a high-risk, high-reward trade. You can be stopped out often because the reversal isn't confirmed yet. If the prediction is right, though, it can be very profitable. Conservative method. This trader waits for the price to break clearly below the neckline support area. Because this method has more confirmation, the risk is lower. Retracement method. These traders wait for a retest of the neckline after it's broken. The limitation? Sometimes the price doesn't retest the neckline, it just keeps falling. These traders are okay with missing some trades, as they prefer high probability entries. Until you master analysis, it's better to stick with the conservative approach. Remember, it's your money, your choice. Stop loss and target. Stop loss, place it a few pips above the right shoulder. If price closes above this level, it may signal that the uptrend is continuing. Target, measure the height from the top of the head down to the neckline. Copy this distance, and project it downward from the neckline breakout point. The level it points to becomes your target. Variations of the pattern. There are three ways this pattern can form. The low of the head matches the previous swing low. The low of the head is slightly higher. The low of the head is even lower. This means the neckline can be horizontal, slanted upwards, or slanted downwards. For the first two cases, an entry after the neckline break usually gives good results. But in the third case, where the neckline is steep and far away from the trend, there might not be much movement left after the break. In this situation, it's better to draw a horizontal line at the low and take an entry only when price crosses below that low. Everything we have discussed here also applies in the opposite way for the inverse head and shoulders pattern, which forms in a downtrend and signals a reversal to the upside. Study this opposite version on your own using the same concepts, and you'll become confident in trading both patterns. That's the full explanation of the head and shoulders pattern.